Let's go ahead and talk about the intercompany sales of depreciable assets. Now, we started these intercompany asset sales discussions with the sale of land, since land doesn't get depreciated. All we really had to worry about each year was restoring the land to its true historical cost and carrying forward the unrealized gain or loss as an adjustment to the investment or retained earnings and perhaps the non-controlling interest accounts. In the case of a depreciable asset, it gets a little bit more complicated because there are more accounts involved. And again, our goal is to make it appear as though the intercompany sale never happened. The problem now is that, again, there are more accounts involved. The reported asset cost, the reported depreciation expense, and the reported accumulated depreciation all have values which differ from what they would have been had the sale not taken place. Not only do we have to adjust the specific asset account back to its true cost, we also have to adjust depreciation expense to its true value and accumulated depreciation to its true value. Let's go ahead and run through an example. Let's go and assume that Big Company owns 80% of Little Company and that Big Company has equipment which they purchased for $100,000 back on January 1st, 2007. The equipment was expected to have a useful life of 5 years with no salvage value. We'll assume straight line depreciation, so basically it's going to be $20,000 per year as depreciation expense. And then 2 years into their ownership of the asset, they sell the equipment to Little for $75,000. And let's assume that the total expected useful life and salvage value are unchanged. In other words, the asset still has 3 years of expected life remaining. First, let's go ahead and figure out what the gain or loss on the sale would be that Big would report. So the asset cost $100,000. They've got 2 years of depreciation at $20,000 per year, or $40,000 of accumulated depreciation, for a $60,000 book value. They sold it for $75,000, which means a gain on sale of $15,000. Now, again, in the case of the land sale we used in the previous example, the gain was realized when the asset was ultimately sold to a third party. Now let's assume this asset won't be sold. It's going to be used for the next 3 years and then it will be scrapped. So this asset is going to be used up over the 3 years of its remaining useful life. The gain is going to be recognized as we use up, as we consume the asset. And it's going to be recognized, $15,000, recognized over 3 years at the rate of $5,000 per year. And it's going to be recognized as an adjustment to depreciation expense. And again, this will make a lot more sense as we go through the example. So let's go ahead and record the sale on Big's books and the purchase on Little's books and see where we stand at the end of 2008 when we're ready to do this consolidation. Now, since the sale occurred on 12/31/08, the 2008 depreciation expense has already been recorded by Big. So to record the sale on Big's books, they take the equipment off their balance sheet, they take the accumulated depreciation off their balance sheet, they record the receipt of cash, and they've got a $15,000 gain on sale. To record the purchase on Little's books, they basically record the purchase of equipment for $75,000. Now let's also see what depreciation expense is and what it should be. Now starting next year, again, Little purchased this thing on December 31st, so starting next year, Little is going to start depreciating this asset. It's got a cost of $75,000. It's got a 3-year remaining useful life, so they're going to depreciate it at $25,000 per year, and we'll call this the reported depreciation expense. Now, we already determined earlier that the true or correct depreciation expense should be $20,000 per year. Again, Big bought this asset for $100,000, had a 5-year life, $20,000 of annual depreciation. So what we're going to be doing is we're going to be, again, we want to report depreciation expense as it should have been, so we're going to go ahead and adjust depreciation expense downward every year from $25,000 down to $20,000. And by adjusting depreciation expense downward, we're adjusting income upwards, and that's how we're recognizing that gain. Again, a $15,000 gain recognized over 3 years, $5,000 per year, and it's going to be recognized as an adjustment to depreciation expense. Now let's go ahead and go through our equity method entry and our elimination entries arising from this transaction. Now, as far as our equity method entry is concerned, that $15,000 gain on sale, which Big reported, is unrealized, and therefore under the full equity method or the complete equity method, we need to reduce our investment income to offset it. So since this was a downstream sale, we're going to eliminate 100% of that $15,000, and we're going to do that by, again, we're going to reduce our investment income and credit our investment in little account. Our elimination entries, again, think of what we have to do. Let's focus solely on the elimination entry arising from this transaction. What do we have to accomplish? Well, first we have to remove the gain on sale, and that's going to be removed in the year of sale only, just as was the case with the intercompany sale of land. We need to restore the asset and its accumulated depreciation accounts to their true values, and we also are going to need to adjust depreciation expense to its true value as well. Now, in this example, item 3 won't apply in the year of sale because we assumed that the asset wasn't sold until December 31st, 2008, which means that the seller, Big, had already taken the correct depreciation of $20,000 per year. But we will have to adjust depreciation expense next year when Little starts reporting that $25,000 annual depreciation expense figure. So for the elimination entries, again, we're going to restore the accounts to their proper level and eliminate or carry forward the unrealized gain or loss. So again, we have to eliminate that gain on sale. We need to restore the equipment account to its true historical cost. Again, the true historical cost is $100,000. That equipment is now sitting on Little's balance sheet at $75,000. So basically, we have to boost the equipment by $25,000 to get it back to its true cost. And third, we need to restore the accumulated depreciation that was eliminated when Big sold that asset. Again, recall that the entry to record the sale of that asset included Big eliminating the $40,000 of accumulated depreciation. Here, we're putting it back on the consolidated balance sheet. Now again, next year, we're going to have to recognize part of the gain by adjusting depreciation expense. But as I said, as I indicated earlier, that's not needed in 2008 since depreciation expense had already been recorded at the proper level. Okay, let's go ahead and go forward to 2009. And let's do our elimination entry first and see how that relates to our equity method entry. So for our elimination entry, again, we need to restore the asset account and the accumulated depreciation to their proper levels and eliminate or carry forward the unrealized gain or loss. So again, we have to boost the equipment account from $75,000 up to $100,000. We've got to put that $40,000 of accumulated depreciation back on the balance sheet, and now we're carrying forward that $15,000 unrealized gain. And again, the two questions we have to resolve is, first, was this an upstream or downstream sale? This was a downstream sale, so the non-controlling interest isn't involved. The second question is the parent using the full equity method or the partial equity method, or the cost method for that matter? In this case, they're using the full equity method, which means that the parent adjusted their investment income to offset the unrealized gain, which means that the parent's income was correct last year, which means the parent's retained earnings is correct. So instead, we're going to adjust the investment in little account. So again, this entry sort of carries forward where we left off last year, and now we're going to go ahead and recognize part of the gain by adjusting depreciation expense. We're killing two birds with one stone. Basically, we're adjusting depreciation expense downwards from $25,000 that Little is reporting down to the $20,000, which would be the true value. And again, we're essentially reversing or undoing $5,000 of depreciation expense. And by correcting that depreciation expense, we're increasing our income by $5,000, in essence realizing or recognizing $5,000 of that $15,000 unrealized gain. So what's happened is we carried forward $15,000 as being unrealized. We just realized $5,000 of it, so we're going to carry forward $10,000 to next year. Now let's go ahead and do our equity method entry. So we've realized or recognized part of the gain by adjusting depreciation expense downwards, which means that under the equity method, we need to record our share, the parent's share, of that additional income. And again, since this was a downstream transaction, we, the parent, get 100% of that. So we're going to go ahead and increase our investment income by $5,000. That's our share of the $5,000 gain that's being recognized. And we debit the investment in a little. And please note the parallel here. Basically, in the elimination entry, we're putting a $5,000 credit on the income statement by crediting depreciation expense, which means that under the equity method entries, we're also putting a $5,000 credit on the income statement. Okay, the year after that, 2010. Let's go ahead and do our elimination entry first, and again, see how that feeds through to our equity method entry. And again, we're going to restore the asset account to its proper level, writing the equipment account from $75,000 up to $100,000. Accumulated depreciation. Recall what we did last year in our elimination entries. We started by crediting accumulated depreciation for $40,000, and then we debited it for $5,000 when we adjusted depreciation expense. So again, we're carrying forward a net $35,000 credit to accumulated depreciation. The difference is that $10,000 of unrealized gain, which is still unrealized. And then we recognize another $5,000 of that by, again, adjusting depreciation expense. And again, the flow through to our equity method entries, again, we're showing a $5,000 credit to depreciation expense. So we're going to go show a $5,000 credit to investment income, recognizing our share of that income adjustment. 2011, the third and final year of the asset's life. And again, we carry forward these values. The equipment account once again gets adjusted upward from $75,000 to $100,000. Accumulated depreciation, we're now carrying forward $30,000. Again, last year in the first entry we credited accumulated depreciation for $35,000, and then we debited it for $5,000. So we're carrying forward $30,000. And the difference is that last $5,000 of unrealized gain, which we then realize by, for the last time, adjusting depreciation expense. And once again, there's a $5,000 increase to our consolidated income, which means there's a $5,000 increase to our investment income. Now that should be all. We've reached the end of the asset's useful life, and the entire $15,000 gain has been realized over 3 years at $5,000 per year. But let's assume that in 2012 the asset is still being used. So although it's fully depreciated, it's still a functioning asset. We decide, hey, let's keep using this asset. As long as the asset is still on the balance sheet, we still have to do our elimination entries, because again, on Little's balance sheet, this asset is sitting on there at a cost of $75,000, less accumulated depreciation of $75,000 for a net book value of 0. The true cost is $100,000. The true accumulated depreciation is $100,000. So basically, we need to restore the equipment and the accumulated depreciation to their correct values, basically tacking on $25,000 onto the equipment and $25,000 onto the accumulated depreciation. The asset still has 0 book value, but at least we've got the underlying information having the correct values. Equity method entry, there isn't any because we're not making any adjustment to our earnings. It might be helpful in looking at this to draw up a little table comparing the reported and true values for the asset and its accumulated depreciation each year, and from that you can see how the elimination entry is getting us from point A to point B, how it's getting us from the reported values to the true values. So for 2008 and 2009, again, this is prior to the adjusting entries at the end of the year and the elimination entries. The reported equipment value was $75,000 at the end of, the reported equipment cost was $75,000 at the end of the year. The true cost is $100,000, so basically we need to be boosting the equipment value by $25,000. Similarly, at the end of 2008, the reported accumulated depreciation is 0 because, again, the accumulated depreciation got wiped out when the asset was sold, while the true value should have been $40,000. So basically, we should have been increasing accumulated depreciation by $40,000. And the same thing would apply in 2009. Again, these are the values prior to the adjusting and elimination entries. So basically, that first year's elimination entry, we increase the equipment by 25,000, we increase the accumulated depreciation by 40, and that's what gets us from the reported values to the true values. It gets us from point A to point B as far as the reported values are concerned. In 2010, again, the equipment account is sitting on Little's balance sheet at 75,000. The true cost is 100,000. So again, we're going to need to increase the equipment by $25,000. Now, the reported accumulated depreciation is $25,000. Little has had the asset for 1 year. They depreciated it for $25,000 back in 2009, and so they would have accumulated depreciation of $25,000. If this asset had never been sold, it would be on Big's balance sheet, and they would have had 3 years of accumulated depreciation at $20,000 per year, or $60,000. So basically, we need to increase the accumulated depreciation from 25 up to 60, or $35,000. And again, that was our initial elimination entry in 2010, where we were carrying forward the accumulated depreciation from the prior year. 2011, same drill. Again, the equipment account's getting kind of repetitive here. Every year the equipment needs to be increased by 25,000. But in terms of the accumulated depreciation, again, Little has now had this asset for 2 years. They've depreciated it for 2 years at 25,000 per year, so it's got reported accumulated depreciation of 50,000. The true accumulated depreciation should be 80,000, 4 years at 20,000 per year. Difference of 30,000, and again, the elimination entry is increasing the accumulated depreciation to get us from the reported 50,000 value to the correct or true $80,000 value. And finally, in 2012, again, the asset was completely used up. It was completely depreciated in 2011. So in 2012, the asset has a 0 book value. But again, the reported values, cost of 75,000 less accumulated depreciation of 75,000, the true values, cost of 100,000, accumulated depreciation of 100,000. So again, our job is to get from point A to point B, to get from the reported values to the true values. And so we increased the equipment and we increased the accumulated depreciation. Almost done. Now, just some last comments. Now, this was a downstream sale, so the non-controlling shareholders were completely uninvolved. If it was an upstream sale, the only differences would have been, first, under the equity method entries, we would only record our share of the unrealized or realized gains. We'd record our share of that initial deferral of $15,000, and subsequently we would report our share of that $5,000 annual recognition. Under the elimination entries, as we carried forward the unrealized gain from the previous period, we would have debited the investment in Little and the non-controlling interest instead of just the investment in Little account. And third and finally, if this had been an upstream sale, the income to the non-controlling shareholders would have been affected by the unrealized/realized income. In fact, let's go ahead and see how this would have affected the income to the non-controlling interest each year if this was a upstream sale. Let's assume that Little reported earnings of $100,000 per year, and that this was an 80% owned subsidiary. The income to the non-controlling interest each year would be, first, in 2008. Again, they're going to get 20% of the adjusted/realized earnings. So we're going to take the reported earnings of $100,000, subtract out the unrealized portion of $15,000, so the non-controlling shareholders will get 20% of $85,000, or $17,000. In 2009, we give back, in a sense, $5,000 of that $15,000 unrealized gain. So they're going to get 20% of $105,000, and the same thing in 2010 and 2011. And again, this is essentially a timing issue. We're shifting the recognition. We're taking that $15,000 away from the 2008 income and then giving it back at $5,000 per year over the following 3 years.